All right, guys, so we are here today. We are coming directly from jiu-jitsu, so I'm a little sweaty, a little bit late, but that's all right. We got the Fomc meeting today, team. How's the market acting? Market's acting pretty neutral today. Still slightly green on the day, it looks like. But yeah, we are coming directly from jiu-jitsu, so I'm burnt out, tired. Just rolled a little bit, and now don't even have time to shower. Had to come straight to the computer. I'll have to shower afterwards. All right, guys, so again, we got the FOMC meeting today. Fed rate hike decision. Almost certainly we're going to come in at a pause today. What's going to matter more than the pause is what Powell actually says during the meeting. Again, we're going to get a today. Poll going. What's going to matter... Does Powell take a dovish or hawkish stance during the press conference? Dovish, hawkish. All right. There's the poll. Vote on that poll. Let me know what you think. Again, we're a little bit late with this today. I didn't even have time to make myself a coffee, which I'm deeply regretting. Deeply regretting. Yeah, all good. Whew. Oh, my portfolio is actually green today, mostly from Oracle, dude. Look at that. Oracle bounced all the way back today, bro. I ended up adding to Walmart and to Oracle overnight, and those are both bouncing back really nicely today. Pfizer's the only red stock that is really influencing my portfolio in a negative way. We added to Exxon, too. And Exxon, we're down a little bit on that one, but that's all right. The meeting's at 2:30. The actual conference is at 2:30. Powell, the decision comes out at 2 p.m. We'll put a timer up so you guys can see it. We got 40 minutes, basically. NVIDIA looking weak. Q down on some today, although it could have been worse. Thoughts on Broadcom? Don't know much about it, to be honest. Tesla recalls? Honestly, I didn't even see that news either. All right, so Tesla's recalling over 2 million vehicles over autopilot safety concerns. This is the fourth update. Autopilot system can be misused by drivers amid a 2-year probe by U.S. auto safety regulators into crashes involving the driver assistance tech. The safety recall covers some Tesla 3S, X, and Y sold in the U.S. between 2012 and 2023. The Highway Traffic Safety Administration said today, or yesterday, they actually said this. The federal auto safety regulator has been scrutinizing the system after years of high-profile crashes and questions about whether the company was promising more than it could deliver. Yeah, I mean, my guess is people are letting it... My guess is people are letting the automated driving do everything instead of using it on occasion like they should. Ooh, all right, guys. Yeah, like I said, man, we are kind of like rough right now, man. We just came straight from jiu-jitsu. I don't know what I'm going to do with the market response to this. We'll see. I don't have a Tesla, no. No, I don't have a Tesla. I kind of need some water, dude. Honestly, y'all don't understand. Like, I literally came straight. I went to jiu-jitsu. Just did 3 rolls, 3 6-minute rolls, and then left before we even like bowed out of the class. Like, drove here, ran into my computer room, and started up the stream. I need some protein, really, but. Hey, thanks so much, V. Rate hike incoming. Nah, rate hike's not coming. JP speaking at 2:30. Yeah, the meeting's at 2:30. The rate hike decision's at 2 p.m. Eastern Standard Time. Slap that like button, guys. I'll be ashamed of you if you don't. I did okay. I mean, my wrist is still pretty torqued, and so I can't really fully roll. First time I rolled today was with a guy who was basically brand new, and I basically pulled guard on him and just kind of let him work a little bit, and I got him in one triangle that I tapped him out with, and then that's basically it. Second roll was with the coach, because the coach realized that my wrist was hurt, and so basically he played full guard and let me try to break his guard and pass, which I struggled with, of course, because he's the coach. Then my third roll was with this guy who's usually pretty good, but he kept shooting for my legs, and I would sprawl, and then I would take his back and north-south, and then roll over and take his back, and then he would do a really good job of tucking his chin, and so I wouldn't be able to get my forearm under his neck. And so then he would roll out of it, and we'd get back in north-south, and he'd try to grab my leg, and we'd sprawl, and then we rinsed and repeated that for about 6 minutes until the round was up. And then that was basically it. That was my jiu-jitsu today. I think a hike is necessary. Hike is not necessary. Again, rate hikes have a lagging effect. They take a year to do anything to the market. Right, the last year and a half, we have raised rates incredibly aggressively to the point where, interest rates on homes are at freaking 8%. And rate hikes are affecting banks the most. If you want to know why interest rates are 8%, it's because we've raised rates incredibly aggressively over the last couple years straight. Now, whether the labor market is cooling or not is going to be the differentiator between whether we should raise or lower rates. But regardless of what we should do, the Fed's not going to raise rates today. The Fed's not going to raise rates. It's just incredibly unlikely that the Fed raises rates. The Fed doesn't like to shock people. They're not really, they don't really like shocking people. And so we're almost certainly going to pause and skip. And my guess is we'll continue to pause rate hikes up until like May of next year is my guess. Yeah, there's a lot of jiu-jitsu jargon, Sam. Point is, first roll, pretty easy, just kind of new guy. I was just like letting him work a little bit. Second roll, coach, I got basically beat up. Third roll, I probably, if anybody considered winning, I probably would consider winning it, but it was mostly, nobody tapped the other one out, so it was basically flat. Bank's doing very well, nearly yearly high on some money center banks. What do you think the FOMC is going to do? Yeah, we're not going to raise rates today, guys. Again, we're just not going to raise rates. We're completely split down the middle in terms of votes. We got 51% dovish, 48% hawkish. Let me do a Twitter poll as well. I haven't done one of these yet. All right. Are you bullish or bearish? All right, so again, we're gonna do a poll in a couple different places. Whew, all right. Yeah, I should grab some water, man. We're just gonna do bull or bear, and then we'll do make this 2 hours long. Pause is coming out of hike. Yeah, we're good. We're not gonna raise rates. We're gonna pause. It's almost certain that we're not gonna raise rates. Again, we're almost certainly gonna pause or skip. We're just probably not gonna raise rates today. Ugh. I'll be right back, guys. I'm gonna go grab a sweater. I'll be right back. But yeah, it's almost certain that we're not. It's almost certain that we're not gonna pause or skip. Again, let me know what you guys think. Yeah, it's almost certain that we're not going to pause or skip. Again, you can look at the Fed Watch tool, the CME Watch tool, and see exactly what the probabilities are regarding this, whether we're going to raise rates or not. You can see we got 32 minutes and 3 seconds. Less than 2% of people think we're actually going to raise rates. For whatever reason, you got a bunch of bearish traders that predict rate hikes when it's super unlikely. And again, maybe today's the day that we shock the system and surprise people. It's just super unlikely. But maybe. I don't know. We'll see. I'll be right back. So I couldn't find any caffeine here. Alright, so again, I couldn't find any caffeine here. All I could find, or I found some caffeine. This is my wife's Mexican coffee, chameleon. Honestly, I've tried this before. It is so strong. I'm kind of scared to try it. Cold brew. It's good. Might be a little bit too strong though. Difference between rate skip or rate pause. The only big difference between a skip and a pause is that one implies that after that specific decision, they're going to go back to raising rates, i.e. a skip. Right? Skip means they're going to skip raising rates for one meeting and go back to raising rates the next meeting. A pause is indefinite. Like, we're currently in a pausing period where we haven't raised rates, I think, since like what? September, July? August, September was the last time we raised rates. And so we're currently in a pause situation where the whole market's basically pausing, expecting a pause. We're almost certainly not going to raise rates. Hey, quick question. How do you trade a market with no history? I'm only asking because we might make new highs from the monthly. It's just momentum, Jeffrey. I'm not sure. However you want to trade it, you know. Gracie-ish. I didn't know who they were. Yeah, the Gracies are good, you know. Bank's doing very well near yearly highs on some money center banks. Yeah. All right, somehow we're green in equities today. Again, I don't know how, but somehow we're green. Powell, same speech. We remain strongly committed to bringing inflation back down to our 2% goal over time. 100%, that's what it's going to say. He's definitely going to say that. What else he's going to say is a different story. Who knows? But he's definitely at least going to say that for sure. All right, so we got some votes. We did this poll 4 minutes ago on Twitter. We got 68.5% of people thinking bullish, 31.5% of people thinking bearish. Where's Bitcoin at today? What's Bitcoin doing? Bitcoin at 42.5. Bitcoin's ripping up. Strong. Interesting enough, the rest of the market's kind of quiet. Look at the Tesla had that big recall that everybody's talking about now. Tesla down to 230s. So I see somebody posting saying we have lost the ability to meet people in person. And basically, you see the stat versus on how many people meet online versus through friends, through family, through work, through bar, through grade school, neighbors, college, so forth and so on, right? And online, the graph is going super steeply higher. Now, that's not a shock, all right? Like, if I was single, like, dude, you're going online, bro. Like, you're gonna give your online, it's like throwing darts at a dartboard. You know what I mean? Like, I'm not saying, like, and there's nothing wrong with that. People acting like that's a bad thing. It just gives people more opportunity, in my opinion. Like, I've got some family that's trying to go out and go to dates and stuff. And I told them, like, look, go meet people online, bro. Tinder it up, you know? Like, that's what you gotta do now. I mean, I guess it's a generational thing. Like, the older generations might not understand. But it's been like this, you know. Like, I met Carol because this girl I knew messaged me online and was like, yo, come over. And we did, and I met Carol there, you know. I mean, that's how people meet nowadays. This was like 15 years ago. Do you think Bitcoin is going up or not? I mean, long term, I think it probably will. Market's gonna tank. He's gonna, yeah. The jobs market's the buzzword that I'm listening for sure. I want to hear what he says about the jobs market. All right. I have no idea what the market's gonna do. Do you ever trade small caps? Not typically, no. The only time I'll ever like dip my feet in small cap territory is if something's starting to squeeze up really big and there's a potential for it to go up much higher, but also huge risk. And so maybe I'll take like a couple shares just to kind of play with it. But it's never something that I have a lot of faith in. I met my wife at the public toilet. I'm not sure why you're saying that over and over and over again, but, you know. Apparently this has turned into where you met your wife history in chat. Yeah, I have no idea what the market's going to do. Yeah, nobody does. Yeah, crypto market's up a lot. Oracle bounced back a ton, man. We bought that dip. Somehow we made money on it. I don't know how. We're also up in Disney again today, too. All right, so we got 600 people here live right now. The FOMC rate hike decision is going to be coming pretty soon, team. It's been a crazy, busy couple months. Thoughts on Disney stock? I mean, I don't know. You'll be able to watch the press conference live right here. Also, just a quick question. Y'all can hear the music, correct? Like, y'all can hear the music, correct? I'm going to test this stream. I'm going to ask you something real quick. I want to see if you guys can actually hear me, okay? So the big question is, can you guys hear me talking now? Thanks. We're going to raise rates in December. You know, that's one thing that you want to pay attention to if you're actually listening to this meeting. All right, did y'all hear that? If you're actually listening to this meeting, raising rates in September, blah, 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 whatever I just said. Did y'all hear that? Okay, I'm trying to make sure that my sound's working. The last time Powell did a press conference, for whatever reason, I was struggling to get everybody to be able to hear that. And so are y'all able to hear that? Okay, good. All right, just checking to make sure. Most of the time I trade the NASDAQ instead of the Q itself, Jamie. All right, good. All right, guys. Hey, we got 22 minutes left. Are we selling gold, bro? I don't know what we are doing. I'm not doing anything. Y'all do whatever y'all want to do. Gold's still sitting at 1995. Like my childhood. What do you guys? Big question here, guys. All right, so again, remember, here, let me break down some economics for you guys. All right, so remember, the Fed raises rates if inflation is out of control. What has the inflation data shown over the last couple months? Well, one of the things it's shown is that inflation is, to a certain extent, under control today. Inflation is an incredibly important thing to pay attention to regarding these rate hike decisions. If inflation is out of control and inflation is really high, the Fed's more likely to raise rates and have a hawkish stance. That's what hawkish means, is a more restrictive monetary policy, meaning they raise rates and they want to push the markets down, the labor market specifically, but a lot of other markets as well. They want to push it down because they want to discourage spending, right? By discouraging spending, when people stop spending as much, businesses lower pricing because they're not getting as many sales because people aren't spending, right? And thus is the reason they raise rates. They raise rates to discourage spending. When they raise rates, they raise the federal funds rate to banks, and in turn, banks raise interest rates to consumers. You know, we know we've had some pretty hawkish monetary policy over the last few years because the Fed has raised rates aggressively, and, you know, interest rates as an example, and mortgages are at 8%. So banks are raising interest rates to consumers, and we're seeing this to a certain extent. Now, though, inflation has slowed heavily. CPI, Consumer Price Index data yesterday showed, you know, that inflation has been slowing down, although it was slightly higher than expected. But the previous couple, you know, CPI reports were all better than expected, and even today's PPI report came in better than expected as well, almost universally for each one, except for one that was neutral, I believe. And so we are starting to see inflation become more stable, is a better way to put it. And with that, for the last couple months, the Fed has chosen to pause rate hikes. They're basically not raising rates. We don't think they're actually going to cut rates until, you know, May of next year, but the Fed hasn't been as aggressive in their rate hikes. They've been pausing rates for the last, 3 months now. What is it? It might be 4.5 months, but this happens every 6 weeks. So every 6 weeks, the Fed makes this decision. At 2 p.m. in about 20 minutes, they are going to announce the decision, which is almost certainly going to be a pause in rate hikes. They're basically not going to raise the federal funds rate anymore right now. And they'll probably indefinitely keep it like this until, again, May of next year is when the analysts think. And again, at 2:30, Powell is going to speak. He's going to do a press conference. He's going to do a Q&A, and that'll be a little bit more interesting to see what happens there. What Powell says, you know, some buzzwords to listen to when Powell talks are recession. What Powell says regarding potential recession predictions, whether we're going to hit a recession or not anytime soon. And remember, a recession is defined as 2 consecutive losing GDP quarters. We also have inflation expectations, like where we think inflation is going to be at. When is the determined period that we think we're going to actually get close to the 2% goal over time? What does the labor market look like? Again, a higher labor market, i.e. more payroll numbers, lower unemployment, you know, higher jobs numbers is typically going to be seen as a negative right now because we want people to stop spending. That's why the Fed's raising rates, or has been raising rates for the last few years. And so that is the nuance of the market right now. That's the economics behind this meeting today. And again, we'll see what happens, guys. We'll see what happens. It is the holiday season. A lot of the time, markets give us what's called a Santa rally during the December months, meaning markets kind of push up a lot. And yeah, it'll be really interesting to see what happens here. Let me know what you guys think. Let me check the chat. We're almost certainly not going to cut rates today, Freddie. So we're almost certainly not going to cut rates. All right, sorry, I'm catching a lot up on chat. Are we selling gold? I don't know. Buy, I don't know. I'm not a crypto guy, but my girl got one at 16.5. And a few days ago, it was at 44,000. Yeah, I mean, Money Mitch had been Zynga told me to buy Bitcoin at 3,500, like 5 years ago. And so, yeah, I mean, again, Bitcoin has the tendency to cause FOMO, and that's all right. Everything causes FOMO if you miss it. I wish I would have bought Amazon 20 years ago, but I think the Fed wants to push the market down. They want to push spending down to a certain extent. Depends on what you define as the market. If you're talking about the stock market, maybe, but mostly they want to push spending down to help inflation. The market is already beyond inflation. As you said, many data is converging in favor of lesser hikes and earlier cuts, and the market isn't making new highs. Yeah, I mean, I think inflation's already under control to a certain extent, really. Who knows when we're going to hit the 2% goal, but I think we already do have some, we have inflation under control to a certain extent. You know what I mean? They paused the rate hikes, NASDAQ and gold pump, correct? No, not necessarily. A pause is overwhelmingly expected. So like, a pause is neutral. A rate hike is a shock to the system. That's bad. A rate cut would be better than expected. If they surprisingly cut rates, the market's probably going to rip. It's just not likely. You know, it's just the same reason raising rates isn't super likely today. We're almost certainly going to pause rate hikes. We're going to watch the speech right here. We're going to cover the full speech live. We're definitely in a recession now. No, not. GDP came out the other day way better than expected. It's not at negative for sure. It's at like, what, 2-point-something% right now for GDP. Yeah, we're definitely not in a recession. You look up what are the signs of a recession. GDP contraction, we're not really getting that yet. We did have the yield curve inversion a while back, but we haven't really had super low output in sales. Sales have been pretty solid still. The unemployment rate's been pretty steady too, in all honesty. To a certain extent, it's almost too steady. You know what I mean? So like unemployment going up, like again, if we were seeing super heavy unemployment and you know, low spending and like low GDP and, you know, then that would be a different story, but we just don't see that right now. Yeah, gold is still under 2,000. It contracted a little bit. You know, if you look at gold here on the right side, gold has been one of the best long-term assets anyway. Gold is 7x over the last 25 years. If you look at it over like a 20-day chart, gold ripped all the way up to $21.52 an ounce. It's all the way back under 2K right now though. Yeah, I mean, the decision's not going to be super influential, Jonathan. I mean, it might move markets, but it's not, unless, okay, if they pause like they're probably going to, it's not going to do much, in my opinion. We might move a little bit, but it's overwhelmingly expected at a pause, right? Like, doing what's expected is not going to really cause that much volatility, in my opinion. If they do anything outside of that, like if they raise rates today, market's going to dump. That's going to make it super volatile. If they cut rates today, market's going to rip up. That's going to make it super volatile. It's just usually like, we're just probably not going to do that. The Fed would have given us more signs regarding that potential decision already, and we just haven't seen those signs yet, you know. I like gold, but there's also an argument in which gold is extended too high. Like, gold is, again, over a 20-year period, gold has gone up a lot. You know, and gold can have gold can have bad years and good years, you know, good decades and bad decades. But the long-term direction of gold obviously is up. And so, like, the 20 teens were not really great years for gold, but the 2020s have been a really solid year for gold. And so the long-term trend of gold is up. Gold's a long-term investment thing, though. Like, gold is something in which long-term investment in gold is usually pretty profitable, but anything under 10 years, there can be volatility. Again, slap that like button, guys. Hit the subscribe button. We should have over 100 likes. We still got over 11 minutes left. Yeah, there we go. Thank you for always streaming like this, even though it's almost 2 a.m. Hey, all good, brother. We try. What's your take, bullish or bearish? I really have no idea. Dovish or hawkish is more my take. 56% of people are dovish, meaning they think we're going to pause or cut. 44% of people are hawkish, meaning they think we're going to raise rates. Not really hawkish or dovish is probably not a good word for it. We're almost certainly not going to raise rates. It's more so what Powell says during the actual meeting is the big thing. We got 1,000 people here. Does the market go up or down from this report? Leave it up in chat right now. Market go up or down from this report, team? Let me know. Up, up. Up, down, up, up. Yeah, I mean, I hope it goes up, right? And maybe this is going to spark the Santa rally. This is probably going to be the biggest economic report that we've had this month. This is definitely the biggest week. Tomorrow we got jobless claims, and then Friday is what's called the quad witching day, right? So Friday is like a very busy day. A very historical day of volatility is the easiest way to put it. So, like, quad witching day is a big day. It's a historical day of volatility in which all major contract types expire. The difference, though, for Friday is that there's no such thing as stock futures anymore. I wish there were, you know, but there's no such thing as stock futures. And so it's really triple witching day, where we got stock options, index options, and index futures are all expiring on Friday. So it's a historical day of volatility. But again, we'll see what happens. Y'all want to see my YouTube? Like, this is my YouTube handle, guys. Look, here's my YouTube interests: mixes, watches, Brazilian jiu-jitsu, music, EA Sports, UFC, gaming, sneaker collecting, cash card games, and stocks. If there wasn't a more degenerate, you know, looking YouTube trends, I don't even know what is, bro. What a degenerate I am, you know. Yeah, we're obviously gonna pause. Stock market has raised a lot in the last month, especially in tech stocks. Not sure if it still have potential to go up. Yeah, we'll see. I want plan, sell, or buy. I don't know what the market's going to do. Nobody's going to tell you what to do here. I'm certainly not going to. Buy the rumor, sell the news? Maybe. Hey, market's down today. We'll see if it goes up after this. Yeah, I'm going to ride the wave too. Yeah, I'm going to play the full stream live here. I'm going to put this up on stream. Yeah, the decision will be announced here at 2 p.m. Subscribe to chat. We appreciate it. Thanks so much. We broke 121,000 subs, so I appreciate it. You know, I'm gonna put it in sub only mode now. We'll see what Big Papa Powell says. Real trading starts tomorrow. Yeah, it's probably a little flat today in anticipation of this report. Bars? You're gonna have to pay more if you want to hear me freestyle, sir. No, I can't freestyle, bro. No, not me. That's not me. I mean, I'm kind of a rap nerd, but I never could freestyle, you know. Yeah, decision comes out at 2 p.m. We got about 1,500 people here live. What's your opinion, hawkish or dovish? I think we're going to pause with a... I think we're going to pause, and I'm going to go with Jerome Powell being dovish during his speech. I think he's going to be optimistic. Let me see what... Okay, so let me see what the last PCE report showed. So the last PCE report showed... So for October, it came in at 3%. So PCE's been going down. It came in at 3% last time. What did payroll numbers show last week? Is it? Let me go back. It does. Okay, good. Last week we had payroll numbers as well as... Let me see. I think we had the JOLTS report last week, right? So last week we had the JOLTS report. Yeah, and JOLTS report came in under expected numbers, signaling a more cooler job market, which is good, right? We want a more cool job market. You know, Fed wants to push the market down. All right, and then Wednesday of last week, we had the non-farm employment change that came in lower than expected. Thursday, we had jobless claims, which is how many people are filing for unemployment, that came in lower than expected. And then Friday, we had unemployment come in lower than expected, which is not really the best. And then non-farm payrolls come in higher than expected, which is not really the best, right? So kind of neutral there. I'm going to go with dovish, although I think it could certainly go either way in terms of what the Fed wants to do. Hey, guys, we got 5 minutes here, 5 minutes. Yeah, what color tie is Powell gonna wear too? I have no idea. We'll see. It better be green. You know, we're gonna have problems if it's not green. I'm not talking about the market. They want to push the job market down. They certainly want to push the job market down. That's why they're raising rates. 25 basis points. No offense, but I don't think you know what you're talking about. Anybody that thinks we're raising rates, I'm just going to assume doesn't know what they're talking about, unless I'm just a dummy guy and we come in at a rate hike today, which is incredibly unlikely. Again, I got to go with historical, bias, where every time we have a meeting like this, you got certain people, I'm just going to call them in a nice word, contrarians, right? Instead of dummies, who think that the market is going to do, they think that the Fed is going to do something wildly outside of expectations, like raise rates today, right? It's almost certain that we don't, and most of the people that are betting on this don't really understand monetary policy like that. But maybe I'm just being condescending, and maybe I'm the dummy, and maybe we do raise rates today. I don't know. I think it's unlikely. I think we're almost certainly going to pause. I think 99% of the world thinks we're going to pause too, and I think the Fed is really... the Fed really likes balance, and so I don't think they're going to shock the market and just kind of dump you know, the market down by doing something wildly outside of expectations. I think we're almost certainly going to pause today, and then if the Fed is hawkish, then they're going to sound hawkish during their speech. If the Fed is dovish, you know, they're going to sound dovish during their speech, but they're going to pause. They're not going to cut. They're not going to raise. They're just going to pause. All right, we got about 2,200 people here. We still got about 2.5 minutes left. I can respect that. I can respect it if you say I'm a bear, I want hawkish. I can respect that. I respect that a lot more than somebody saying that somebody's trying to shame me for thinking that we're gonna do what's wildly expected. You know, which you get a lot too. I hope they lower rates. They're not going to. They're not going to raise rates either. If the Fed is bull, the dollar's going up. What do you mean by the Fed is bull? Dollar's going to go up if the market goes down. And if the market goes down, the dollar's going to go up. And if the market goes up, the dollar's going to go down. Market and the dollar index are going to do the opposite to each other, because you have to think sitting on cash and investing are opposing things. You know, if cash is gaining value, you're going to sit on cash. If cash is losing value, you're going to invest it in other things, you know. And so you got to think about it in that regard with inflation too. But, and metals will always go down. All right. Y'all slap that like button, hit that subscribe button. We got about a minute left. We got 2,400, about 2,500 people here live. Yeah, at the very least, hit the like button. I mean, I'm never going to shame you guys, but I'll hate you forever if you don't. Do it now. Elon Musk is planning to start a university in Austin, Texas. Musk University. I think Elon's going to run for, you know, political power, in my opinion, is his next move. All right, guys. Hey, we got 25 seconds. 30 seconds left. Y'all hit the live button next to the play button. You want to make sure your live button looks like this, team. We got 30 seconds here. You want to make sure your live button looks like this. All right. You want to make sure your live button is nice and red. You want a red dot next to live. It means you're fully caught up. If you put it in 2x speed, you'll be fully caught up. You won't have to worry about it. All right. We got about 3,000 people here live. Get ready. Let me pull the page up. All right, guys. All right, here we go. Let's watch the market. All right, market's pushing up a little bit. Waiting for the report. Report's not dropping yet. We gotta wait for it to reset. It's almost certain to pause, and this looks like a pause too. Okay, there it is. And whoa, what is this? They got a new graph here. Interesting. Wait, they changed it. I don't know what they changed it to, bro. They changed it. The Fed leaves rate unchanged. They paused. They left it at 5.25% to 5.5%. They changed where it went. Usually they put it at a different spot. Now they're throwing graphs up here. Weird. That's odd. Okay, here it is. Maintain the target range of the federal funds rate from 5.25% to 5.5%. I'll put this up. So yeah, they paused, like I just said. Market seems to like this a lot, I guess. And hey, I'm for it. Bitcoin ripping up to 43,000. Q all the way back up to over $400 a share here. My stock portfolio's ripping up. You love to see it. I'll take it. I didn't think we'd have such a bullish reaction, but maybe. Hey, I'm not complaining about it for sure. My portfolio is looking really nice right now. Walmart's surging up. SPY's ripping up. PayPal is up. Oracle is up. Nike's up. Netflix is up. Yeah, I mean, again, gold is up over 2,000. So we've actually had a really big bounce up on this, which is kind of a shock, in all honesty. Like, this is kind of a shock that we're going to move up. Like, everybody knew we were going to pause. I told you guys we would pause. Market's freaking weird sometimes, dude. But hey, I'm for it. Let it rise here, guys. Let it rip. All right, so again, Powell is going to do his speech. Powell is going to do his speech at 2:30. Again, we're going to put a timer up. Powell's speech is going to drop at 2:30 Eastern Standard Time. So y'all be ready. Again, Powell's speech is going to drop at 2:30 Eastern Standard Time. Be ready. Again, Q is ripping up. Gold is ripping up. Honestly, this is great. I love this. You love to see this. Honestly, you really do. I'm like a kid in a candy store right now. I mean, this is good. Again, I'm holding a bunch of stuff long term. And I'll take it. Again, I added a bunch to Oracle. The one stock that's not doing great in my portfolio is Pfizer today, but that's all right. Just to show you guys why I'm so happy all of a sudden. This is my portfolio. I went from being up $30 on the day all of a sudden to being up about $270 on the day. We're about $265. And man, look at gold skyrocket up too. I'm in gold as well. Hey, you love to see it. Will this hold is the question, guys. Will this hold? I'm going to put another timer up here so you guys can check it out too. Here, let me fix this timer. All right, we got, I'm just going to call it 26 and a half minutes left. There we go. We got this timer up. We're waiting for the press conference. Again, we'll put this up so you guys can see. If they held the rate, why dollar went down? I told you guys, if the market goes up, the dollar index is going down. So I don't even have to look at the dollar index to understand the dollar index is dumping right now. Why? Because the stock market went up. Right? They're opposing forces most of the time. Usually there's an inverse correlation with these. Not always, most of the time. Right? And again, we're going to stream. What's going to matter more than this individual decision is what Powell says. So again, what's going to matter more than this individual decision is what Powell says. So again, that's what we're sitting tight waiting on. Go ahead and take a little bit off of Walgreens here. We're already in it. Let's go and lock some in. There we go. Cut it. All right, so we just took some off of Walgreens. Y'all good. The decision, let me put the decision up. So yeah, they left the rate unchanged. They didn't raise rates. They left the rate unchanged. So we kept it at 5.25% to 5.5%. All right, put this up so you guys can see it. There's the rate. Fed leaves rate unchanged. They paused like we told you guys they would. Yeah, we're going to stream the full meeting live here like we always do, team. Of course. And again, if you haven't already, check out Top Step. If you want to day trade in the futures market, try out Top Step. If you want to day trade some of these economic reports, the futures market is the best way to do so with less red tape. Most day traders make a mistake. They try to do like a cash account and only go long with like a $2,000 account. It's just not worth it. You're going to be so restricted. You're only going to be able to go long. It's just not what profitable day traders do. Most pro day traders actually trade futures because there's no PDT rule in futures, and you can use a margin account and day trade in futures, no PDT rule. You can day trade the S&P, the NASDAQ, currencies, gold, and silver. Patterns are very similar to blue chip stocks. There's just no PDT rule, right? You can day trade it short. That's what a lot of people miss about the futures market. The other benefit is that they have these funded account programs, which are great tests of skill. So like you can test your skill in the futures market, and if you lose on these funded account programs, it's not the end of the world. Like most day traders lose money. I'm very open and honest about the fact that most day traders lose, and so you can either put up thousands of dollars yourself trying to look cool, or you can try a funded account program. If you lose, you're only out what you paid for the funded account program. If you're good enough to pass Top Step, like they give you a demo, they test your skill. The base one's $50. If you're good enough to pass it, they fund you $50K in the base one with a 90% split. So you're keeping most of your profit once you're funded anyway. There's just noticeably less risk, and in that way it makes tons of sense. Like again, you can either try to look cool on the internet, and most day traders lose money. I'm very open and honest about that. Or you can try a funded account program, limit your risk, and again, you'll probably still lose in day trading because most day traders lose. It doesn't matter whether they're on Top Step or not, but it's just a lot cheaper. And so again, if you want to check that out, I'll put this link up. Great way to help support the channel. I'm certainly biased in their favor because they pay me money, so I'm certainly biased in their favor. Very transparent about that. Hey, check it out right here. Great way to help support your boy. All right, so we are dipping down a little bit. We are at 401 on the Q right now, 401 on the Q. The dollar index dumped a little bit. It might start bouncing if the equities market bounces. Man, my wife is the worst with timing. I guess I'll call her, but like... All right, guys, sorry. No, sorry, my wife called me. Yeah, this one's not CFDs, though. Powell speaking at 2:30, guys. There's a timer in the top left. No, I'm just jumping because I have restless leg syndrome. Right, so like, I'm just jumping from restless legs. But yeah, Powell speaking at 2:30. We'll see how that goes. Again, I hope he says something positive. Will Powell be dovish or hawkish is the question. I have no freaking idea. I hope he's bullish. I hope he's dovish. But nobody knows what Powell's going to say, what Powell's going to do. Yeah. All right, so again, market's looking really nice right now. Oracle, we're actually almost green in it after gapping down that huge amount. We're still in PayPal. It's up nicely today too. Took some off of Walgreens, Walmart, Exxon. All right, guys, 20 minutes. You think it would be slightly hawkish considering non-farm payroll data last week? Maybe. I mean, payroll data did come in above expectations on Friday. So, yeah, I mean, it's possible. The Q looks pretty resilient, though. I mean, look, the Q up to 401. So the thing you got to understand about the NASDAQ here, which is the Q, right? The Q is the NASDAQ. And again, when I say you can day trade the NASDAQ in futures, you can essentially get access to the same price action as the Q in futures, no PDT rule. The lifetime high on the Q is 408.70s. 408.70. So we're getting pretty close to that. The QQQ is up to almost 402s right now. Here's 402 right there. So we're getting pretty close to lifetime highs on the Q, and it's been a few years since either any of the big exchanges have been close to lifetime highs. So definitely an interesting dynamic in market here, guys. And yeah, we'll see. Chewy about to be acquired, maybe. Let me look at our polls here. We did a bunch of polls. Pretty sure it'll be hawkish. He wants to avoid stagflation like we were seeing now. Maybe. Again, I'm going to go with bullish, but who knows, man. The market's actually ripping up a lot, surprisingly. We were red on Walgreens, but it's actually finally starting to go a little bit more green for us. I'm just hoping he says positive, optimistic things. I think once Powell starts speaking. Yeah, maybe. Hey, I'm for it, man. I hope he says something positive. We'll see. Next week we do have some stuff too, man. We've got like, to give you examples, next week we have, I think we have PCE next week, the personal consumption expenditure, which is actually the Fed's preferred inflation metric. So next week we have GDP next week. Quarter 3 revision, 5.2% is what's expected. And we have PCE data. And so next week's actually kind of boring, except for Thursday. I thought we were busier next week here. Is the market closed? I thought I looked at this already. But yeah. Q's still dipping down a little bit. Very nicely green on the day. The dollar index is looking weak also, which is usually an okay sign. Building permits and housing starts. CB consumer confidence, existing home sales, GDP jobless claims, Philly Fed index. Friday we're gonna have PCE data. So yeah, the Fed's preferred inflation metric is actually PCE. You said you hope that it will be dovish. Oh no, I certainly have no idea what he's gonna say. Nobody does. We're all just freaking guessing here, unless you're insiders in the Fed themselves. I have no freaking idea what he's gonna say. Literally no idea. Again, it's just a coin flip. I have genuinely no idea what he's gonna say. I hope it's positive. I hope it's optimistic. I hope it's dovish. But whether it's actually going to be is a completely different story, a completely different thing. Which again, I have no freaking idea if it's going to be or not. So yeah, again, I hope it's optimistic, but we'll see. Confirmation bias means that I think it's gonna go. I think he's gonna be dovish. But again, I genuinely have no idea. You want to see Carol's new hair? Hey, Carol, show him your new hair. Sorry, it's my wife. I gotta. Carol, come here. Let's see if I can get her to come in here. Will you give your interpretation of Jerome's statement in real time so I can execute trades accordingly? Kind of. I don't want you to copy me. I have no idea what I'm talking about. I might be wildly wrong about everything I say. But kind of. When he speaks, what do we look out for? So when he speaks, there's a couple buzzwords that you want to pay attention to. The main one being recession, like if he thinks we're going to hit a recession anytime soon, if he thinks we're going to do a soft landing, what the labor market looks like. If he thinks the labor market's too resilient, that's typically a bad sign, a negative sign. Where he thinks inflation is at, when he thinks we're going to hit our 2% goal over time, what are the obstacles in that regard, about when we're going to hit that goal over time. What the plan is for monetary policy moving forward into 2024, i.e. whether we're going to raise rates, pause, or when we're going to actually start cutting rates. An earlier prediction on when we're going to actually start cutting rates could be seen as optimistic in markets, and a later prediction on when we're going to start cutting rates could be seen as a negative thing in markets as well. So. Yeah, those freaking climate people, man. Again, they're lurking in the shadows waiting for Powell, bro. These guys, Powell freaking hates them. They're like his nemesises. Now, these climate activists, man, they're just waiting for Powell to say 2 words, and they're jumping out screaming, yelling. Hurting Powell shine. He's not happy about it. They need to make a movie about it, personally. They're just waiting. They're lurking in the shadows, just waiting to pop out. Honestly, if they're there today, I'm going to laugh because they have been there for every major Powell talk. They're not going to be there today, though. Again, the only people they let in there are like really esteemed journalists that they already know. It's basically the same journalists. It's the club. All right, guys. Hey. You guys ready? And again, if you haven't already, check out TopStep, funded account program and futures. They give you a demo. They test your skill. If you want to day trade, again, you can try to put up the money up yourself, or you can try a funded account program like me. The better option is going to be trying a funded account program like me, because again, funded account program, there's no PDT rule. You can day trade short. You can buy market, sell market, all that good stuff. Just less risk. No PDT rule. Market is kind of choppy a little bit ahead of this report, though. So the market is kind of neutral ahead of this report. And again, you can either put the money up yourself day trading. Again, Top Step is the most legit funded program. They've been around for over 10 years. They pay out millions, fund thousands a year. Yes, they are a sponsor of mine, but I do use them pretty regularly. You can check them out here. I'm pretty sure it works if you're in the UK, but check with them. But yeah, there's the link. All right, team. We are day trading a little bit here. Here's the NASDAQ. We are currently up $30 here, $40. I'm just buying the top of the range, 60, 70. We're going to go ahead and cut that. And this is on Top Step. It's a platform called Quant Tower. So you can see we're starting this one off on this account. We are up $85 on the day. My goal is like I build up a cushion first, and then we take larger risks once I have that cushion built. Right? That way, if I lose, I'm back to kind of break even. If I take larger risks, if I don't lose and I'm able to kind of build up a larger cushion, then I'll take larger risks if I need to, if I'm trying to get funded or whatever it is. Hey, thank you, AD. I appreciate the 6, whatever that is. Thanks so much, man. I appreciate it. Let's take an activism a little farther than necessary. Yeah, I mean, I think people really enjoying your channel and how you explain yourself. I can't stand when people push people to do not smart things. Yeah, I mean, I'm pretty easygoing with how I run it. I got a couple pet peeves. Don't shame the other side, you know. Don't shame the other side. You know, again, I always use the Dunning-Kruger, you know, definitions for people who think they know everything in markets. Nobody freaking knows what's going to happen. Nobody does. The people that tend to act like they know the most and shame other people for not knowing typically know the least. And so, market just ripped up, broke highs. Q almost back up to 402s. We're not doing anything, celebs. Do whatever you want to do, brother. Yeah, I think people just want a reason. Like, I'm not against activism, right? But it depends on what it is. If it's super radical, then usually people are just struggling, right? And it depends on what it is, of course. Like, I'm okay if you're vegan. Just don't hate me if I don't choose to be, you know? They'll say a cut. They said they're probably going to start cutting in May, I think is what they said last time, Nathan, but I'm not sure exactly what we're going to do. You know? All right, guys. Hey, we got 8.5 minutes here. 8.5 minutes. I don't even know if I monetized this stream. Okay, yeah, I did good. I mean, I'm in Texas. I like barbecue too much. You know what I mean? Like I like barbecue just a tad bit too much to like, you know, maybe I'm selfish. I don't freaking know. Where's Apple at? Apple's getting close to lifetime highs as well, huh? Yeah, look at Apple. see what the Fed says. Again, the market's up a lot ahead of this Fed report, which means that we might have some vulnerability. Q just broke highs again. It's at 402 plus. Yeah, we're gonna play the full live speech here of Powell. Guys, don't worry. We're gonna play the full live speech. Yeah, don't worry. We're gonna play the full speech. All right. Yeah, we're on hold waiting for the speech now. You can hear the cheesy, horrible hold music. Where'd it go? Man, NASDAQ's just flying up here, team. We're gonna put this up, get this ready. We fix this a little bit. We'll put the Dixie up, the Q up on the top, on the left side. Sorry, bear with me here, team. Maybe put what other chart do you guys want up? Gold, baby? Put gold up. We got the dollar index up. We got the Q up. Here's Apple. Apple's like surging right now. Here's the Q. Sorry, I'm trying to like get this to work. Fix this a little bit. Is that good? No, that's right in the way. I'm dumb. Okay. Switch sides here. There we go. And then we'll try to maybe put... Where's the other little chart I had? Here it is. You want to leave Apple up, or y'all want something else besides Apple? Put like gold up. Here's gold. Yeah, look at gold. Gold up to 2022s. All right, that looks pretty good, huh? All right, team, you guys ready? Hey, thanks so much, man. Watching me from... Yeah, man, these climate activists. Can you start casting at 4K? You know, there was a camera that did 4K, but like, to be honest, the quality was always kind of worse. All right, guys. Hey, we got 3.5 minutes. 3.5 minutes. We got 3,000 people here. Yeah, anybody that's mad about 2 ads that we did, like, y'all could cry about it. Like, in the end, everything we put out there is free. I don't claim to be a good trader. I don't claim to be an expert. I don't charge for any of my content whatsoever. Everything we put out there is free. I don't sell a course. And so you better believe we're going to have sponsors. And y'all could cry about it. In the end, we do what? Two sponsors so far, and what, a 2.5 hour stream. Very reasonable, you know, very reasonable. And again, we even do better than everybody else. We literally tell you, hey, look, we're biased in their favor because they pay me money and they're a sponsor of mine. Nobody else does that, you know. So again, if you're still crying about it, you might be being unreasonable. And thank you, D. Hey, thanks. Love from India. Hey, thanks so much, man. What will Powell say? What will Powell say? Will he say close the door? Are the climate protesters going to jump out at Powell? That's the other question. Here, that's the other question. Opening line, good afternoon. The Fed remains committed to its 2% inflation goal over time. Yeah, that's definitely going to happen. Nah, I'm not going to sell a course. Bro, I would get so much hate if I sold a course, dude. It's all good. I appreciate the love. I would get so much hate if I sold a course, dude. Again, everybody would hate me. And I don't really want to claim to be good. Like, I would rather just say I'm not good. And, you know. I have no idea whether the ETF spot Bitcoin thing is going to get approved or not. I hope it gets approved, but I have no freaking idea whether it's going to. We should have made Powell bingo cards. Hey, thanks, see the world. Do the ads once the storm is passed, not right in the middle of it. I mean, there's no storm right now. The storm hasn't even started yet. We're just sitting here, bored. All right, team. You guys ready? Here we go. All right, so y'all can hear the cheesy do-do-do music, correct? We got less than a minute before this thing's supposed to start. Yeah, they're not going to raise rates today, guys. They're just not going to raise rates. I mean, again, they may be... Again, I'll eat my words if they do, but they're almost certainly not. They already paused. So, I mean, they're not raising rates. It's already happened. Actually, I don't even know what I'm talking about. They've already said they were pausing rates. They didn't raise rates today. We're not going to do anything until 6 weeks from now. So yeah, I told you guys. Every time we get all these people saying, we're going to raise rates, watch. Never do. Always do. Anything outside of expected. I'm talking nonsense over here. Here we go. All right, you guys ready? All right. Let me turn this music off. Volume's up. Can y'all hear this? Or no, it's not. They're not actually saying anything yet. Okay, good. All right, guys, you guys ready? All right, pal, where you at, bro? Here he is. Purple tie, guys. Purple tie. He's got a purple tie.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I think it's mostly dovish, optimistic.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did, and I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters would expect very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks, really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year, at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year, are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time, but it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't. But in any case, we have to do what we think is right. And in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total, as we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Go to Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire?
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria?
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year, and you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook. Right.
So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay. And do you see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, you know, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and you know, I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this, you know, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there's something different about the U.S. economy.
Yeah, so it's not that, it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, you know, we had the view, my colleagues and I broadly had the view that we could get a lot of, you know, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, you know, something like that has happened. It happened so far. The question is, you know, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to, you know, to to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance. And, it's so far so good, although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
Thank you.
Thanks very much.
All right, guys, so that is Powell. Hey, listen, I just want to say this. Chat, y'all are freaking hilarious, man. Y'all really are. Again, we're a bunch of degenerates here, so that's okay. We could be degenerates. Again, like I said, you got to look at my actual, YouTube interests here to see, I'm a degenerate, too. Here's my YouTube interest, if you didn't know. Mixes, watches, music, gaming, Brazilian Jiu-Jitsu, World Series of Poker, stocks, and sneaker collecting. There's never been a more degenerate look on YouTube, in my opinion. But hey, listen, let me know what you guys think. I'm just going to say this. I'm not going to say I told you so. But I definitely told all of you we were probably going to pause and dovish talks afterwards. And what did we get? We got a pause. We got dovish talks. Optimism reigns here today with Powell, with the purple tie. Listen. I told you guys. I'm not going to say I told you, but I definitely did. You're welcome, okay? Top 3 greatest FOMC predictors in the world right now. Listen, I have no idea what I'm talking about. I might be wildly wrong about everything, but I'm definitely one of the top 3 FOMC predictors in the world. If you haven't already, check out Top Step. Somebody said, hey, Mr. Powell, have you tried Top Step? Check out Top Step, funded account program and futures. If you want to day trade, and most day traders lose money, because again, we're a bunch of degenerates here. That's what we do. You're going to lose money in day trading, almost certainly. Almost all day traders lose. You could either try to look cool on the internet, putting money up yourself and lose thousands of dollars, or you could try a funded account program like Top Step. It's the most legit one in the world. They've been around for over a decade. They pay out millions in actual withdrawals every year. They fund thousands of traders a year. Again, most day traders lose. It takes years to be successful. Again, you could put the money up yourself, or you could try a funded account program. They're going to give you a demo. And if you could pass the test, if you could make $3K in profit on that base demo on Top Step without losing over $2,000, they fund you $50K as long as you can follow their rules with a 90% split when you're funded. So once you're funded, it's similar to putting the money up yourself, but your risk is noticeably less. It's the best of both worlds. There's no PDT rule in futures. You can day trade short, all that good stuff. You can check out the link right here. Great way to help support the channel. We are going to be doing a crypto show. Guys, listen, do not go anywhere. We are going to do a crypto show. That crypto show is about to start up right now. Do not go anywhere. If for whatever reason it doesn't bring you to the crypto show, go to this link. All right, here's the crypto show we're doing. We haven't done a crypto show in a minute. There's the link. Check it out. Great way to help support your boy here. There's the channel for the crypto. Again, as soon as I hit in stream, it should redirect you to the crypto channel. And we're going to talk about Bitcoin, spot ETFs, altcoins, all this good stuff. I appreciate the love. Thanks so much, guys. And yeah, hey, that's how we do it here, over here. Again, hit the subscribe button, hit the notification bell. As soon as I end the closed stream, it's immediately going to bring you to this other stream that we're doing, this crypto stream. Again, it should bring you right there. I don't know where my business partner Cam is. He hasn't joined the stream. Where is he? Dang, dude, this dude's sending me like 30 links, bro. We're going to be going over some news today in crypto. Again, I'm going to click in stream. It's going to bring you to this crypto channel. All right, we're going to start the stream up right now. Again, if it doesn't bring you, there's Cam. There he is. All right, Cam. We got Cam over here. All right, if it doesn't bring you to this stream, go to the link in the chat. All right. I'll see you guys over there.